HCA Healthcare posted a massive top and bottom line beat for the second quarter of 2026. We're talking $20.23 billion in revenue and diluted earnings per share of 7.62.
Right, which looks incredible on paper.
Yeah, exactly. A nearly 12% jump in earnings year over year. But despite those headline beats, management immediately poured cold water on the print. I mean, they slashed full-year guidance across the board.
Yeah, and that sent a complete shockwave through the healthcare sector.
Totally. Revenue expectations are now narrowed to a ceiling of $79.5 billion. Adjusted EBITDA guidance is dialed back to the $15.4 to $16.1 billion range, and MPS projections were cut to between 28.70 and 30.50.
That's a really stark contrast to that quarterly beat.
Right. So today's deep dive is about tearing into the underlying mechanics of HCA's latest report to uncover why the largest hospital system in the U.S. is flashing these serious warning signs, despite reporting over $20 billion in quarterly revenue.
Because that divergence, the headline beats versus the forward guidance cut, is really the entire story here. When you look at the raw growth metrics for Q2, you see a mature healthcare system putting up numbers that look, honestly, fundamentally robust.
I mean, that $20.23 billion in top-line revenue is an 8.7% increase from Q2 of last year.
Exactly. Net income came in at $1.699 billion. And foot traffic across their 190 hospitals and 2,600 ambulatory sites is actually accelerating.
Yeah, let's look at that traffic. Same facility admissions increased 2.5%. Equivalent admissions, which, scales their outpatient volume against inpatient revenues, rose 2.7%, and ER visits jumped by 3.6%.
And they are extracting more yield from that foot traffic, too. Same facility revenue per equivalent admission grew 6.4% year over year.
So you combine higher overall volume with higher revenue per unit of volume, and you get that 8.7% jump in the top line.
Right, but this is exactly where the income statement starts masking the actual operating reality.
Because when you look at the cash flow statement, the narrative just completely fractured.
Oh, completely.
Their operating cash flow, the actual, liquid cash generated by the hospital's daily operations, it nearly halved. It dropped from $4.21 billion a year ago down to just $2.335 billion this quarter.
Yeah, that is a glaring drop.
Right. You don't lose $2 billion in operating cash flow in a single quarter by accident, especially when net income is actually up. It means the mechanics of how and when HCA actually collects cash are basically seizing up.
Yeah, and it comes down to accrual accounting. That allows a company to book revenue when the service is rendered, not when the physical cash is collected.
Okay.
So when net income rises, but operating cash flow collapses by nearly 50%, it signals a massive buildup in receivables, or just a huge mismatch in working capital.
Meaning they're treating patients and billing for those services, driving up that top line.
Exactly. But the physical cash isn't hitting the bank accounts at the same velocity. To understand why that cash conversion is deteriorating, you have to look at their underlying service mix.
Right. The actual acuity and profitability of the services they're providing are shifting drastically. General admissions and ER visits are up, like we said, but highly profitable surgical volumes actually went into contraction.
Yeah. Same facility, inpatient surgeries dropped 2.3%, and outpatient surgeries fell 3.4%.
Think of a hospital like a bustling restaurant, right? The dining room is absolutely packed. There's a wait list out the door. The staff is running frantically.
A great way to visualize it.
But every single person sitting at a table is only ordering tap water and breadsticks while nobody is buying the expensive dry-aged steaks. The sheer volume of traffic is high, but the high-margin products are just sitting untouched in the freezer.
Right, and the operating leverage in a hospital system works exactly like that restaurant. Surgical lines, orthopedics, cardiovascular suites, neurosurgery. Those are the stakes.
And you have huge overhead, right?
Massive fixed overhead costs. You have to maintain the sterile environments, the robotic surgical equipment, and these highly specialized, highly compensated surgical teams. And you pay for that, regardless of whether you do 10 surgeries a day or two.
Wow. So when surgical volume drops even 2 or 3%, the operating leverage just heavily works against you.
Exactly. It severely compresses the margin. ER visits and general medical admissions often carry much lower margins. So when HCA reports a decline in surgical volume, alongside that 3.6% jump in ER visits, the actual unit economics of the hospital are degrading.
They're doing more labor-intensive work, but a lower percentage of it is highly profitable.
Precisely.
But, the margin compression from losing those surgical volumes is really just the tip of the iceberg here.
Oh, yeah. It gets worse.
Because the far more dangerous threat to HCA's cash flow right now isn't just a shift in what medical services patients are using, but a fundamental breakdown in who is actually paying for them.
Right, the payer mix.
Exactly. This report reveals a massive billion-dollar headwind that basically completely explains their guidance cut. In Q2 alone, HCA took a $400 million unfavorable hit to their income before taxes.
And it's worth noting that includes a $75 million bleed over from their Q1 estimates.
Right. And then management formally revised their full-year estimate for this specific headwind upward. I mean, previously they thought this would cost the business between $600 and $900 million in 2026.
And now they are bracing for a $1.0 to $1.2 billion hit.
Over $1 billion wiped out from a single dynamic. They attribute this to a, quote, payer mix shift driven by an increase in uninsured volume. Specifically, patients losing their coverage on the health insurance exchanges.
Right.
But wait, I want to challenge the assumption here for a second. ER visits are up 3.6% and total admissions are up. If a retail chain saw a 3.6% increase in foot traffic, even if those customers were buying lower margin goods, it's still a net positive for gross profit.
That's true for retail, yeah.
So why does this specific influx of uninsured patients act as such a toxic drag on a hospital's balance sheet?
Because a hospital ER operates under entirely different regulatory and economic mandates than any other consumer business.
Okay.
Under EMTELA, which is the federal law governing emergency medical treatment, a hospital is legally required to stabilize and treat anyone who walks through the doors of an ER.
Regardless of their insurance status?
Exactly, regardless of whether they have insurance or any ability to pay. So when a patient loses their commercial insurance on the exchange and becomes uninsured, their underlying health issues obviously don't disappear.
Right.
Their utilization simply shifts away from primary care clinics, which require payment up front, to the emergency room, which literally cannot turn them away.
Wow. So the ER essentially becomes the default primary care provider for the uninsured population.
Exactly, and the unit economics of that shift are just brutal for the hospital operator. When an uninsured patient comes into the ER, HCA expends real, immediate operating cash nursing wages, physician time, diagnostic imaging, disposable supplies.
But they still book the revenue for that encounter, right?
They do. They book it at their standard rates, which temporarily props up the top-line revenue numbers we talked about earlier. But the collectability of self-pay, uninsured medical debt is historically abysmal. HCA explicitly flags this in their risk factors, the escalating amount, and the risk of collectability of uninsured accounts.
So the hospital incurs the immediate cash expense, books a massive receivable they will likely never collect, and eventually just has to write it off as uncompensated care.
Exactly. It creates a severe drag on margins. The payer mix is shifting away from commercial exchange insurance, which reimburses at highly profitable rates, toward a population that simply has no structural mechanism to pay the bill.
Wow, that structural reality perfectly explains that massive drop in operating cash flow. If top-line revenue is growing by 8.7%, but a large chunk of that is uncollectible, uninsured billing, the cash flow statement is going to violently detach from the income statement.
It's phantom revenue.
Phantom revenue, exactly. But this actually brings up a glaring contradiction in the Q2 numbers. If HCA took a $400 million direct hit from uninsured patients in this quarter, and their high-margin surgeries are contracting, you would expect their core operating profitability to just absolutely tank.
Right, you would think so.
Instead, adjusted EBITDA actually grew 4.6% year over year to $4.027 billion. If the core operating mechanics are degrading that severely, how is the adjusted EBITDA still expanding?
Because the losses from the uninsured population were almost perfectly offset by a massive injection of capital from the state. Yeah, during the second quarter, HCA recognized approximately $400 million of incremental net benefit from Medicaid supplemental payment programs.
And the lion's share of that benefit came from one specific state-directed payment program in Florida, which was just recently approved by CMS, the Centers for Medicare and Medicaid Services.
Right.
The scale of this single government program on HCA's quarterly financials is honestly staggering.
It is. State-directed payment programs are these really complex financial mechanisms designed to keep the hospital safety net intact. Because Medicaid base rates, the standard amount a state pays a hospital for treating a Medicaid patient, are notoriously low.
Like, they don't even cover the actual cost of care, right?
Often they don't.
Yeah.
So to prevent hospitals from going bankrupt under the weight of Medicaid and uninsured populations, states like Florida create these supplemental pools.
Okay, how does that work?
They essentially levy an assessment basically a provider tax, on the hospitals themselves. The state takes that tax revenue, uses it to claim matching funds from the federal government, and then redistributes that newly enlarged pool of money back to the hospitals based on their Medicaid volumes.
Which perfectly explains the bizarre accounting entries in this report, because the Florida program didn't just hand HCA a $400 million check.
No, not at all.
The report shows the program added $1.372 billion to Q2 revenues, but it also added $829 million in operating expenses.
Right, the expenses the provider tax HCA had to pay into the Florida system, and the revenue is the federal and state matched funds they received back.
And the net difference there is the $400 million benefit that magically canceled out the $400 million uninsured hit.
Exactly.
But the timing of this program is where the cash flow story gets even darker, because a massive portion of this was applied retroactively.
Yes.
Of those amounts, $980 million of the revenue and $557 million of the expenses related to time periods prior to 2026, dating all the way back to October 2024.
A huge retroactive adjustment.
And because of this massive injection, HCA completely revised its 2026 Medicaid outlook. They had been projecting a loss of $50 to $250 million from Medicaid programs for the year. Now they are forecasting a gain of $300 to $500 million.
And that retroactive application is actually pretty standard for these types of CMS approvals. The administrative process for a state to launch a directed payment program, get it vetted, and receive federal approval, it can take years.
Wow. So from October 2024 until the middle of 2026, HCA had to operate its Florida facilities, treat all those elevated Medicaid and uninsured volumes, and just float all of those operating costs out of its own working capital.
Exactly. They were bleeding cash on the expectation that the program would eventually be approved. When CMS finally gave the green light this quarter, 18 months of backlogged revenue and matched expenses suddenly hit the income statement all at once.
Which completely closes the loop on the operating cash flow collapse. If you have almost $1 billion of retroactive revenue hitting the income statement in Q2, your net income and EBITDA are going to look fantastic.
Right.
But if the state of Florida hasn't actually wired the physical cash for that entire 18-month backlog yet, it just sits on the balance sheet as a massive receivable. Meanwhile, HCA might have already paid out the $557 million retroactive assessment expense in real cash to true up the pool.
Exactly. You book the profit, but you drain your liquidity to do it. The income statement records the economic right to the revenue, but the cash flow statement reveals the incredible friction of government bureaucracy.
That is wild.
Yeah, and this extreme lumpiness is a structural reality for the entire hospital sector. They are heavily dependent on these supplemental programs to balance the scales against the uninsured headwinds, but the cash conversion cycles are incredibly unpredictable.
So we're looking at a quarter where the underlying operations, the surgical volumes and the commercial insurance payer mix are actively decaying, but the quarter's profitability was functionally bailed out by a massive retroactive Medicaid approval in a single state.
That's the reality, yeah.
And that brings us to management's outlook for the remainder of 2026 and their capital allocation strategy, which frankly looks entirely contradictory.
How so?
Well, on one hand, management clearly acknowledges the operating environment is deteriorating. They lowered full-year guidance across the board. They recognize the billion-dollar headwind from the insurance exchange isn't going anywhere.
Right.
Yet, while bracing for operational impact, they are deploying capital like a company in hypergrowth. In Q2 alone, HCA repurchased 4.752 million shares of its own stock.
Yeah, for over $2 billion.
Right, $2.064 billion. Doing the math on that, they were buying back their own equity at an average price of roughly $434 per share. And they still have $7.2 billion authorized for future buybacks.
They're aggressive, yeah.
Very. They maintained a 78-cent per share quarterly dividend. They're holding firm on $5.0 to $5.5 billion in capital expenditures for the year. To me, buying back $2 billion of stock while simultaneously cutting your earnings guidance, it just reads like management is trying to artificially prop up their EPS by shrinking the share count, because they know the core operating margins are failing. Is that too cynical of a read?
Well, it's a very common critique of share repurchases, but I think you have to evaluate the capital allocation against the absolute scale of HCA's balance sheet, not just the quarter-over-quarter margin pressure.
Okay.
They aren't necessarily manufacturing EPS growth. They are defending their capital base.
Yeah.
Even after lowering their 2026 guidance, this company is still projecting over $15 billion in adjusted EBITDA for the year.
Yeah, that is an enormous cash-generating engine.
Exactly. And as of June 30th, They are sitting on $1.013 billion in cash and equivalents, with another $3 billion in availability under their credit facilities, and a total asset base of over $63 billion. So a $2 billion buyback is actually a strategic use of excess leverage for them.
But is it the best use of capital when your business faces intense, immediate physical risks? I mean, the earnings report explicitly flags the material impact of natural disasters, specifically calling out the physical risks from changing global weather patterns and severe hurricanes like Milton and Helene.
That's a huge factor in Florida, yeah.
Exactly. When your business consists of physical brick-and-mortar hospitals concentrated heavily in coastal states, extreme weather isn't just some abstract concept. It's a direct threat to patient volume, facility integrity, and supply chains. Why drain $2 billion in liquidity to buy back stock at $434 a share when you might need that cash to rebuild a roof in Tampa next month?
Because holding excess cash on the balance sheet is ultimately a drag on overall return on invested capital. Management teams use share repurchases when they believe their equity is undervalued relative to the long-term, through-the-cycle cash-generating power of the business, regardless of short-term weather disruptions or regulatory delays.
So they're just shrinking the pie.
Exactly. By retiring 4.75 million shares, they reduce the total number of slices in the equity pie. Even if the total EBITDA pie shrinks slightly this year, due to the uninsured payer mix shift, each remaining share now owns a structurally larger percentage of the cash flow.
Ah, I see.
It is a massive signal to the institutional markets. Management is essentially stating that despite the noise of the insurance exchanges and the unpredictable Medicaid timing, they have absolute confidence in their market share and their ability to command pricing power over the long term.
Which makes sense. I mean, this report ultimately serves as a real-time stress test for the entire U.S. healthcare sector. HCA's numbers prove just how delicate the financial balancing act is for American hospitals.
It really is a high-wire act.
They're entirely dependent on this fragile, interconnected web of government and private funding mechanisms. When commercial coverage or exchange insurance drops, the hospitals instantly absorb the pain on the front lines in the form of uncompensated ER care.
Right.
And they just have to rely on complex, heavily delayed state Medicaid programs to act as the ultimate financial backstop.
It perfectly illustrates that operational excellence inside the hospital, performing the surgeries, treating the patients, is really only half the business. The other half is navigating an incredibly complex labyrinth of reimbursement policies, state taxes, and federal matching funds.
Right. Which brings us to a massive systemic risk buried in the forward-looking statements of this report, one that every investor in the healthcare space needs to be modeling for right now.
Oh, the EPTCs.
Exactly. HCA explicitly flags the looming expiration of enhanced premium tax credits, or EPTCs, at the end of 2025. These are the federal subsidies enacted over the last few years that basically capped premium contributions and made health insurance exchanges affordable for millions of Americans.
Yeah, those subsidies are exactly what drove record enrollment on these changes in the first place.
Right. So if those subsidies are allowed to expire, premiums are going to spike and disenrollment will accelerate exponentially. If HCA took a revised billion-dollar hit to their income this year just from standard baseline shifts in exchange coverage,
then the expiration of the EPTCs next year represents a massive multi-billion-dollar cliff approaching the entire industry.
Exactly. It would trigger a flood of uninsured volume into emergency rooms nationwide, severely testing the limits of those state Medicaid safety nets we just discussed.
Honestly, the expiration of the enhanced premium tax credits is arguably the single most important macro variable for healthcare economics over the next 18 months. It will completely redefine hospital payer mixes across the country.
It's definitely a cliff we'll be tracking closely, along with the cash flow metrics from the rest of the healthcare sector. Make sure to follow the show for daily earnings coverage, financial analysis, and deep dives just like this one. Thanks for joining the conversation today.